Hey traders, Steven here with TradesPlan.com. It is Thursday, February 28th. We're going to look at a lot as usual. We're going to look at the overall indices and where I think that the potential support could be. There's a lot of signs showing that we could, on the next pullback, that it probably could be more of just a pullback to correction than full blown, all the way take another test of this. So we're going to look at some evidence on that. China continues to be strong. We're going to look at some individual ETFs. We're just going to look at the full evidence to see kind of where we think the market is going. So I really want to start with the Nasdaq. This rally is just continue to show resilience, and it's getting pretty long in the tooth. I've been saying that probably for a couple weeks now, but I always notice that rallies sometimes just tend to overshoot, and that's just really what happens. Now, right now, the Nasdaq is above the 200-day, above the 20-day, and above the 50-day. So eventually, this 20-day moving average, kind of what I call the rally line, it's going to break. So, and I don't know when, obviously. I'm continuing to try to have a, play the bull and look for setups as much as possible instead of trying to just support more evidence. To find evidence to support a theory that I think the market is potentially going to come down here. And one of the reasons why I think we're going to look at lots of reasons for why that potentially I think we could eventually get out of this bear market, or this bear market rally could turn into a new bull market. So we're going to look at that. But, when I'm looking for potential support zone, I'm really looking into this 7,200 to 7,100 zone. There's a lot of price action in here, and it clearly took that out in the rally, but it's not realistic for the rally line to hold, forever. Eventually it's going to break and it's going to pull back. So, when I'm just kind of looking at everything, I'm kind of analyzing the market. I'm saying, okay, where is a lot of the volume? Where's a lot of the price action, a lot of the congestion, really? And you can see right here that this, when it came down to test the 20-day moving averages, it, went down to 69.53, but it was really closed above this 7,000 level. So that's really where I'm looking to. I think it'll kind of pull back into this zone. I don't think there's just a specific price that says, hey, here's where it's going to come down to exactly. But I am looking for bullish opportunities, and I'm at a point where I'm going to let the market come to me a little bit. I have positions, I have stops. I still own plenty of stock. Kind of at a point where I'd be incredibly selective at buying anything new right now, at least until the market comes to me a little bit. But if it comes down in this zone, I see that as more of, potential bullish setups than a potential threat to just come all the way back down here. So we'll keep an eye on it. Before I get down into this, so the 50-day moving average, we have to look, is still under the 200-day moving average, but curling up. So I kind of want to see the test of that curl to see if that holds. So this went down very quick, and this came back up very quick. If you look at this other side here, it seems very reasonable that it will create a handle or even create a shoulder over here to kind of pull back, cock back, and ready to go. So that's really what I'm looking for. So this is a chart going all the way back down here to January 1st of 2018. I got the SPY, the SP 500 with dividends. So I'm looking in the last 14 months, the S&P 500 is really only up 6.8%. So that's not a ton. We look at historical averages, we're hoping, 8% for an individual ETF or a mutual fund. Obviously, we trade stocks for greater returns, but there's been a lot of chop, right? A lot of 10% moves either way. So, in this kind of, when you're not looking at the candle and you're just kind of looking, you can kind of see that the momentum seems to be slowing a little bit, and I think that's okay, kind of as it enters back up into this neckline a little bit. One could easily say that it's already broken, but we have to kind of look at what we think is reasonable, and I think a pullback is reasonable. I'm more comfortable letting the market come to me before I continue to back up the truck a little bit. But, kind of how my personality is, and part of my trade plan is over a 12-month cycle, I'm going to get out, I'm okay with performing in line in a strong rally or even slightly underperforming an overall rally. where I get a lot of outperformance is just the full 12 months, the full market cycle, right? So I like, as part of my trade plan, I'm very comfortable. I like a smooth equity curve. So I'm definitely going to sit this out because a lot of times my stops start to get ran right around here. So I'm going to sit out most of this to help smooth my equity curve. So over time, when you're not playing from behind as much, you can afford to even underperform a rally by a point or two and still beat that rally because you're not having to play as much catch up. I hope that makes sense. So, but just kind of looking at this, there has been a lot of chop along the way, and you know, we're above where we were 4 months ago, but not by a ton. So if you kind of look back, it's been a major rally in the last 2 months, but if you look back the last 14 months, we're slightly ahead. I assume this will pull back a little bit eventually. Nasdaq up more, which is good. That's kind of where you want it to be. But if we look at the SPY, it is really only back to the late January high of 2018. I mean, it's not back to this high, it's back to this high. So, and I don't think that's significant because this high got taken out right here. But my point is that even if you go back 13 months, the market hadn't budged, okay? So I think it's okay. I think it's important for us to really say, okay, what do I want out of my trade plan? Where do I want to be in 12 months? And make sure you have a trade plan and stick to it to not only handle the rallies, but make sure that you're not giving too much of your portfolio back when, the corrections or the bear markets happen. Okay? So let's continue, and we just really looked at the SPY, so I'm going to get into the breadth. So the short-term breadth is still bullish. I think the percent of stocks above the S&P 500 are still above 70%. The percent of stocks in the S&P 500 above the 20-day moving average are still 81%. That's still pretty bullish to me right there. Tech is strong. Financials are the strongest at 95%. And I continue to go through all these, and what's showing a little bit of early sign of weakness is healthcare. It kind of crossed under that line, and this is more of a rally line. This isn't the end all be all, right? I like the longer term breadth indicators because I like less whipsaws. But if we go here, staples are starting to increase. I'd say energy is definitely the weakest from a rally breadth standpoint. But utilities is still way up there. It's still strong. So I'm not going to look at just one sector and say, okay, that's reason to be bullish or that's reason to be bearish. Most of them are bullish, and that's really enough for me to continue to say, okay, maybe we do get out of this, even if, this breadth does weaken a little bit, even down to the 50% mark. Let's just continue to try to look for bullish setups. If I go to the percent of stocks above the 200-day moving average in the S&P 500, I mean, we're at 69.4%. I mean, that's a straight shot up. Now, as you know, what goes straight up will come back down eventually, but that's a pretty good thrust right there. I mean, there are some major stocks buying off the bottom, so I'm continuing to keep in mind the thrust. I'm continuing to keep in mind that the thrust does need a reset eventually, and that's kind of when I'm going to be looking to, really see how aggressive I can go. So right now, I'd say the overall breadth is healthy, and it will weaken when the rally weakens, but it's still healthy. So you just sometimes when I'm not looking for reasons to sell. You have stocks in place, you have stops in place. I'm still hanging in there with my positions, and I'm going to see if it'll go higher. Maybe the pullback is just minor, or it's going to hit my stop. Either way, I got some good positions. I own them, and I'm going to let them run or not. We'll just kind of wait and see. But I feel good about my trade plan, and at the end of the day, we all have to respect our own trade plan and do what we're comfortable with. So this is looking at the last 12 months. I'm looking at the SPY. This is a look back period of 12 months. I'm looking at the SPY. I'm looking at the VEU, which is the international stock ETF minus the US. I'm looking at T-bills, So from a momentum standpoint, when you can have certain look back periods, you can see right here that on a 12-month look back period, now the S&P 500 is the strongest. So, and international stocks are the weakest, and you can tell just in the last month when this indicator went back, where, you know, the U.S. stocks are starting to outperform T-bills in the last 12 months. Now, you might say, well, what happens at the 6-month mark? Well, we can look at that too. Nope, that was 6 years. Let me look at 6 months, because some people use 6 months, some people use 12 months. A lot of times I do tend to like to go with a longer term, just because, you know, I like less whipsaws. And the shorter the time frame, the more whipsaws you're going to have. I'd rather have a lagging indicator with less whipsaws than a very active indicator with more whipsaws. So right here in the last 6 months, you can see that T-bills are up, and both the SPY and the international stocks is down from a between 3.5% to 4%, both of them. So you can see in the last 6 months, these two ETFs have been in line. So in the shorter time frame, you would still say bonds are, you know, or excuse me, T-bills are the winner. In the last 12 months, stocks are starting to kind of really, that indicator is starting to look better. So again, I'm trying to look at evidence. I'm looking at breadth thrust, even though the breadth will weaken. I'm looking at, you know, the look back, the momentum indicators. I'm trying to look at a lot of different things to say, okay, what's going to support the evidence of a potential, you know, just retest of the lows, or a potential, you know, pullback / minor correction. And I'm really thinking there's more evidence in the latter. So if we look at, I want to show you a chart. I want to look at the VIX. So this is the volatility index and the fear gauge, what they call it. And I'm really kind of looking at the last, you know, major market corrections or bear markets. So I have, you know, the 2008, I have 2011, which was almost 20%. I have the 2015, 2016, and then I have the current bear market. So the green line is the low of the VIX when the bear market started. So I'm going to prove a point here. So you have, you know, in the 2008, the low of the VIX was 16. So you can see there was kind of support around 16. When the pullback, you know, really started to happen, at least the way I see it, in 2011, when the market got really nasty, really the low of the VIX was way up here until we got out of it, this blue line, this support line, and then we really started to kind of get out of it. You can see right here. So the VIX stayed up there, and then when it started to really come down lower, we started to get out of it. Of course, there's pullbacks along the way, but I think for the most part, I say that when the VIX broke this line, we got out of it. Then in 2015 and 2016, you can see the VIX got down to 14.33 when it rallied, and then it took its second leg down, and then it thrusted back up. But you can see on the thrust back up, even though the second leg undercut the first leg, the VIX did not. The VIX stayed lower. And I'm looking at a weekly chart. So what's my point? On this bear market, there's so far has been a V-shaped bear market. You had the VIX come all the way down to 13.5. There's not a lot of fear in the market, at least at this stage. It could change tomorrow. It could change next week. But look at where all the blue lines, they all line up. In this bear market, the VIX has got, in my opinion, really lower than in the previous bear markets or corrections. And this isn't an exact science, you know, this is just more of analysis, but I'm looking at this and saying, there just doesn't seem to be a lot of fear right now if the market were to take a second leg down in a retest. It's kind of telling me that it might seem more likely to do a 50% retracement, or the 7,000 to 7,100 area that we previously talked about in the Nasdaq, but the VIX is pretty low, so it's just kind of hard for, and it's up this week, so it's back up to 14.5, and it could get back up here, but again, obviously the VIX is going to spike if we get any pullback or correction, but I'm more looking at, like, okay, is that pullback correction an opportunity? And it just seems like it is. It seems like it is. But the only time will tell if I'm right on that. So if we look at the S&P 500 relative chart, So this is a relative ratio of the small caps versus the S&P 500, the Nasdaq, and the IBD 50 growth stocks, ETF. So really, you can see that when the purple line's going down, I mean small caps are underperforming. The S&P 500, when it's going up, they're outperforming. Obviously, in a bull market, you want to see some outperformance, right? You want to see outperformance in the more aggressive sectors. Well, the trend line right here, it's in my opinion, is broken. And this is an 8-month down trend line. So I think that is a legitimate trend line. It's been touched a couple times. So really, small caps have underperformed since the middle of June, large caps of last year. And now it's starting to kind of break some horizontal necklines. It's starting to break the downtrend line. I'd see this as a bullish development. The Nasdaq is right on it, okay? That's not a definitive breakout. So far, we've got one of the three. I think the IBD 50 is not even at the trend line yet. I don't even know where I draw it because there's so much chop around here. So again, these are relative ratio charts. This means over the last 8 months, the Nasdaq has underperformed the S&P 500, but that relative chart is getting close to breaking out. So to me, that would be a positive. If there was a definitive breakout, I think that would be a positive development. Obviously, you can see on this most recent rally that the Nasdaq's been outperforming, which is normal. All right, when the market rallies, typically the Nasdaq and the small caps are going to outperform. Same thing with the IBD 50. It's been outperforming on the rally. But again, I'm not looking for it just to outperform on a single rally. I'm kind of looking for a longer term. And you can see since it's peaked that we're at some key pivot points, and it could kind of test this line and come back and then pull back for a few weeks or a month and break out then. But it's getting close. Again, this is getting real close. So, you know, with the VIX just being really low, breadth being strong, and we know eventually all these are going to pull back. But again, they're getting really close to turning if some of them haven't already. So looking for opportunities when the market pulls back. If I look at GDX, let's look at gold for a second. And I really have the same chart because the only thing that's really changed is gold is, or at least miners have pulled back hard. You know, it came back, pulled back to support, broke out surge, broke out of a flag, and it came back very quickly, and that's just what gold does. Like, there is no smooth path to success in gold miners. My Achilles heel. But, you know, to kind of look at this, it's right back at this support zone. I think this breakout has the potential to fail. You can see that if I were to draw a trend line on GLD up here, it's probably very close to breaking if it's not already. I could probably even draw it where it is breaking. So let me kind of see if I can get one under here. Let me pull that down, see if it touches. So you can see right here, it's starting to break a little bit. I wouldn't say that's the end-all be-all break because it's not that definitive, but momentum is definitely weakening, and at the very least, I think gold looks like it needs a breather. So it's just really kind of something to keep an eye on because it's been really strong, and the last couple of weeks is pulling back, and it's pulling back hard, and I'm looking at GLD, I'm like, okay, this looks like it wants to consolidate. Gold miners are still outperforming the metals, and it's been a chop along the way. So, you know, I would say that if this pivot breaks right here, this is a relative ratio chart, then I would just be careful about loading up on miners. And I know a couple weeks ago I was incredibly bullish, played a miner, made a little bit of money. I've played some miner ETFs, made some money, but I think as far as, you know, where gold has been since 2011, it has been incredibly hard for gold to have, you know, just a really, really long-term momentum strength. And that's just kind of the way it is because the dollar is still up here. You know, if we look at the dollar, it's still consolidating. It's in the same place that it was all the way back in mid-August. So it really hasn't done much. Yes, it broke this trend line, but it hasn't rolled over. It's still hanging in there. So right now, it's consolidating within an uptrend. So we got to keep that in mind when we're looking at the gold and all that fun stuff. So if I were to go to the Shanghai and we look at a chart going back to 2014, I'd say the downtrend is over. I mean, look at this break right here, right? It completely broke this 2016 low and just kind of opening the doors for more. But, you know, I don't even need to draw a trend line to show that is broken. And what I think is even more interesting and more important down here, let me make these lines just a little bit smaller. So I do have just make them really super thin, just to make it easier to see. This is a relative ratio chart with the Shanghai versus the S&P 500, and it has been in a downtrend since 2015. This is a legit trend line. You know, and then you have so it just broke out, and then you have a horizontal breakout. I don't think it's broke above this pivot, but it's definitely broke above the downtrend and is really threatening. So as you can see what the Shanghai does, it has the potential to go parabolic. And when I'm looking at this chart, and I'm like, when I did this last week, it was like right at the line. Now I'm looking at this week, it's clearly breaking out of the downtrend, and just the Shanghai has just thrusted higher. To me, this is just really signaling a new bull market in the Chinese market. And the correlation you can see in the S&P 500 is really kind of all over the place. So I think the Shanghai has plenty of times throughout history where it's not really that correlated with the S&P 500 versus the S&P 500 in Europe, or highly correlated. The Asian markets can beat to their own, march to their own drumbeat. So, which I think is important and interesting, especially when you don't know what the overall market's going to do. It really hasn't done much, and even though it's surging, it hasn't done much in 12 to 14 months. So I'm looking at it and saying, okay, I'm always open to new ideas that will potentially not always be correlated with the overall market, right? That's a part of my trade plan. I try to have things that I buy that are not correlated with the market. That way, when you come in and you get a 3 to 4 day whack in the tech stocks, you know, just that haircut, I mean, those stocks can be down 5% a day. I don't like that feeling when everything I own is getting just beat up. So it's just part of my personal trade plan. I try to be as conservative as possible with a smooth equity curve. But my point is, I think this is a chart that's worth taking notice. And, you know, if we can go and look, we'll kind of stay on the China train for a minute. Let me really pull some ETFs over here. Just kind of take a look at, you know, my list of 250 ETFs. So I look at, now this is, look at what has really been strong. Out of 250 ETFs in the last 3 months, look at where China all of a sudden is. This ASHR. You know, if we look at the weekly chart, man, that's some big popping right there. Now, it is extended, right? It needs to come in. But I think that this is enough evidence to support with everything that I'm showing you that it's time to really just pay attention to some of these Asian ETFs, because though they are correlated, not so much as with the overall market. So, and if we stay here a second, you know, this Renaissance IPO is way up here. But look at what's close to the top. Clean Energy ETF. This is at a 52-week high, is really going all the way back, is at a 4-year high. So, or almost a 4-year high, 3.5. So I think that is incredibly important. Look at the solar right up there with it. So again, clean energy is really leading the pack the last 3 months. And then we have software stocks. You have a software ETF right here. This is at an all-time high. Not a lot right now is at an all-time high. So it's kind of hard to be too bearish when software stocks are just surging, right? And they're surging out of here. So we also have this something to look at on the China side. You know, there are a couple hundred Chinese ADRs listed on the U.S. exchange, but you know, these Chinese internet stocks, they can really move. Now, there's a lot of volatility, so you know, maybe you play an ETF, but this KWEB, KWEB, these China internet stocks, you know, this is showing a lot of relative strength the last 3 months. So, you know, a couple ETFs to look at, maybe keep an eye on for your own personal watch list, or just to see how the development goes. But I think that is showing really a lot of strength. So let's continue this, and I don't think I even did anything. Oh yeah, I did. Okay, let's continue to kind of keep an eye on the overall market. So I want to look at the sector summary for a second, just so we can see what's strong today. Bearish stuff is strong today, even though the market really hasn't done much. So you have REITs, staples, and utilities. And this also could be that yields, I wonder if yields are popping today. or excuse me, let's kind of look at yields here in a second, or it could just be defensive names are leading today, and it's kind of a mixed bag. You see tech's still kind of middle, but REITs are strong, staples are strong, utilities strong. Let's look at what's happened the last week. Last 1 week, you still have technology way up there. So again, we still have a bullish trend, a bullish rally. I do think it's going to pull back, but today, one day, I've shown several days where utilities are leading and the market continues to go up. Like it shakes off any news. So just really something to really keep an eye on. But I think that technology stocks are something you want to look at if the market comes into a little bit and eases a little bit. So if we were to go to more of a individual industry ETFs, I got about 25 that I typically track. You can see that REITs are strong, which that confirms what we just looked at. But let's really look at what's been strong, from a 12-month relative strength rating. Come back to this software ETF. The software stocks have just rallied. Think of Coupa, COUP. I mean, this thing just rallied out of there. So there is a lot of strength coming out of here. And this is good to pay attention to because there was a bear market in these stocks, clear as day, and now they're coming out really strong. So the base counts are reset, it resets the deck, shakes out all the weak holders, and then it continues to go on. So again, I'm kind of looking for a handle in this. You can also see the gold miners have been strong, but still in the last, you could say since 2014, they're below their 2014 high. Have still gone nowhere, right? Even though you do have the golden cross, they've still gone nowhere. So it could go back range bound. Just keep an eye on it week by week, but still have not done a whole lot. Medical devices, you can see this ETF. This ETF is just under a 52 all-time high. It's kind of hard. So you have some very aggressive ETFs. Even the hack ETF, cybersecurity, it is close to an all-time high, 1% under. Hard to be too bearish with that. Utilities are up there, but I think the fact that software dominates utilities, I'm okay with that, even though utilities is at an all-time high. So let's look at what is, showing some relative weakness. So oil is still weak. So you have XES, XOP, steel, oil is still weak. If we look at, it's breaking the 20-day moving average today. So it could come back and test this zone a little bit. So I would just be cautious. I thought it was going to roll over right here. It did not. It continued to grind higher, but you can kind of see what the curve is doing right here. So we'll keep an eye on this. I think this has definitely a good chance of testing the 50-day moving average area. So kind of see some weakness in some of the miners and some of the, even though the miner has been strong as of lately, but the bank stocks have been, even though they're down here on a 12-month basis, they've been incredibly strong. And if you remember what we looked at on the breadth of the XLF, financials were very high. They were one of the strongest individual sectors. So just because something's at the bottom of the 12-month, that's why I always like to look at the 3-month, and I kind of go back to my ETF list, because what I'm trying to do is I'm trying to see what new trends are emerging, and I'd say 2 to 3 months is a good time frame to look at trends and say, okay, can I catch something that's been down for a while and starting to curl up? Can I catch something early in a trend? So I hope this was helpful. Let me know if you have any questions.